Fios is not cable. We're wired differently, which means you can get the fastest internet available with equal upload and download speeds from 50 to 500 megs. So you can upload 200 photos before your favorite song is finished. Click the ad and switch to Fios today to get our best offer ever.
This is a download from BFM 89.9, the business station.
Morning, Dodge. The U.S. markets plunged more than 3% on Friday. And, people are talking about all sorts of spooky predictors indicating extreme overvaluation in the U.S. markets. I mean, we have the double cross, the Schiller's Cape ratio, Tobin's Q ratio. Some of these things, I don't really understand what they are. But what were some of the causes of the crash? And is this a sign of more bad things to come?
Good morning, Julian. Well, with our market, the termites have been working very hard beneath the market's technical structure. While the major averages of all four of them have maintained their strength and have been looking upward, fewer and fewer companies have actually been participating. It's like the generals going up the hill, leading the army, and then looking back and finding out that fewer and fewer troops are moving forward with them. Our selling pressure has continued to increase and now outweighs the buying power that we're seeing in the market. And you can measure that by looking at when a stock trades, does it trade on the bid or the offer, and that determines which one it is. Our earnings season has not been very formidable. And remember, it's really not the news, but the market's response to the news that matters. And the glass was seen as half full. Now it's more than empty, more empty now. But with fairly significant geopolitical events continuing and their risk being perceived over here as well, our market really has transitioned to selling rallies rather than buying dips.
Now, you spoke about the reporting season earlier. Did this explain a lot of the dumping that happened in the market?
Well, it is significant that this is the first time during our earnings season we've had a big difference this time because we're looking at 3 consecutive quarters of earnings declines. If you exclude the oil companies, we have a 1% to 2% earnings growth. It's not really terrific. And there is an increasing reliance and dependence on management's ability to manage the future. I mean, you take a look at Disney. They're having a programming question now. ESPN, with their live sports, historically has been immune to pullbacks, but we still don't know the role that ESPN is going to provide and other cable properties will play when we go to streaming television. Also with Walmart, you look at the change in retail. The delivery system is changing where people can go to a store, look at thousands of different alternatives, and then order online in the store. What is Walmart going to do with that challenge? So you have major companies having to show that their management is able to adapt, and that's really a question that's coming much more to the fore. So you have earnings, a little weakness, a real lack of growth, a concern about management, a conviction that management will be able to come through as they have in the past, but they have to prove themselves now. This creates a much different environment and a much different reaction to earnings.
Some of the U.S. indicators, economic indicators like GDP growth, employment, consumer confidence seem to point to a recovery that is on the mend. How is this different from the very tentative reporting results season that we're seeing, and they're causing some people to see this as a market that is glass half empty?
Well, it's a perception that what is going on in the U.S., it's not clear as to whether, for example, our U.S. data showed on an August factory order index falling. And our investors are really watching economic data now for clues on when the Federal Reserve is going to raise their interest rates. So there needs to be a clarity on when interest rates are going to rise. And one of the indicators that we're watching, and you talked about all these fantastic technical indicators, but let's keep it very simple. If you take a look at at any security's average price over the last 200 trading days, just the closing price, add them up and divide by 200, that gives you a sense of where the average longer-term investor is at break-even. When a stock goes below that, Julian, then those longer-term investors really have to ask a question: do they want to stay in the stock, having seen pretty good profits, pretty good increase in the price, or are they going to take this opportunity to sell? So that one indicator, the 200-day moving average for any particular security, is a pretty good indicator, and it's not particularly technically sophisticated, but it does tell you how investors are reacting to what is happening economically. And right now what we're seeing is that there's a difference between the company and the stock of a company. And right now the stock of a company is undergoing much more pressure than the fundamentals of a company would provide.
A lot of people are blaming the emerging markets in China for this big sell-off. Is this a circular argument? Because the rout in China and emerging markets are due to what's happening in the United States, coming from rising interest rates and providing strength to the dollar.
Well, Julian, they're really two very separate issues. Yes, they're tied together, but they're very different. One is the clarity on China currency, and the other is the clarity on whether U.S. interest rates are going to go up. And right now, Julian, we are seeing a very different perception about that second one. If the Federal Reserve doesn't increase interest rates in September, and it's more likely that it will not now, the perception is that perhaps the U.S. economy is in worse shape than what was expected. So now it is viewed as bad news as opposed to previously where it was a delay in increasing interest rate was viewed as good news. So that is a very different concern with the market right now. Then you look at China and the emerging markets. China obviously isn't the only country resorting to extraordinary measures to shore up their stock market. You look at Taiwan, they slapped on a ban on short selling of borrowed stocks. So they can't short them at prices lower than the previous day's close. You look at South Korea, the finance ministry said it will act preemptively. You look at Taiwan, Hong Kong, Indonesia have entered technically their bear markets. So it's really essential that Asian governments don't panic and resort to short-term oriented decisions in order to respond to what is going on in the markets. That is a very different issue. So while the two come together because we really are sectored markets in the global economy, they are very different and they are being treated differently by each market.
Will the absence of an interest rate rise in September give more fuel to the market? And what are you doing now with your investments?
We were planning on interest rates going up, and we viewed that as being positive, and we were finally getting going. I'm not so sure that it's going to happen, and that would be viewed as bad news. We are not buying the dip right now. We have experienced the bottom, but we don't foresee that to be the bottom. But at the same point, we are not selling. In fact, we expect to have a short-term rally, and it could be quite emphatic over the next 2 or 3 days. This is what happens when you have the majority of the volume on the downside as opposed to the upside. They're called 90% days, and we had one on Friday. So we suspect that over the next 3 or 4 days, there's going to be a good rally. And overall, Julian, we also suspect that there may be a a return to the positive market. But ultimately, we think longer term, over the next 2 months, we suspect that we're going to be headed downward. So we're being very careful. We would suggest that investors create their own rules. For example, not to have a loss of more than 8%, 10%, whatever, and to really abide by it. In other words, to develop a very strict discipline and to ask the longer-term questions. Is the company that you're invested in, does it have the management that can respond to the changing environment which is going on now technically?
Thank you. That was Dorland, Chief Investments Officer at Landor and Fuest Capital Managers in New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.
This year, I will chew 117 number 2 pencils.
I will doodle 9 Staples notebooks to death.
When it comes to school supplies, it's guaranteed your kids will go through a lot.
I'll make a whole lot of paper airplanes.
I will lose my backpack.
That's why you get guaranteed savings for back to school at Staples.
I'll give away my last pen to Nathan in math class.
Get guaranteed savings at Staples, and right now, 1 subject notebooks for just a penny with a $5 purchase. Staples, that was easy. Valid on select SKUs while supplies last. Limit 6.